In this video, I am going to share with you my analysis of CapitaLand Ascendas REIT stock forecast and price target. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and as you know, I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth for quite some time now. The Investing Iguana was recently ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've also produced over 500 videos with more than 200,000 watch hours as of August 2024. Today, we're diving into an interesting REIT that's been catching my eye lately. CapitaLand Ascendas REIT, trading under the ticker A17U on the Singapore Exchange, has been a hot topic among investors recently. As one of Singapore's largest REITs focused on business spaces and industrial properties, it's definitely worth our attention. Let's start by looking at the analyst ratings for A17U. Currently, we have 3 analysts giving their opinions on this stock. Interestingly, all 3 of them have given A17U a strong buy rating. This unanimous positive sentiment is quite rare and definitely catches my attention. It suggests that these analysts see significant potential in CapitaLand Ascendas REIT's future performance. Now, let's talk about the price target. Based on the forecasts from these 3 Wall Street analysts over the last 3 months, the average 12-month price target for A17U is $325. This represents a potential upside of 11.55% from the current price of $291. The highest price target is $344, while the lowest is $305. What does this mean for us as investors? Well, it suggests that even the most conservative estimate sees some upside potential for A17U. The spread between the high and low targets isn't too wide either, indicating a relatively consistent outlook among analysts. But remember, friends, we shouldn't blindly follow analyst predictions. Let's dig a bit deeper into why these analysts might be so bullish on A17U. CapitaLand Ascendas REIT has a strong portfolio of properties across Singapore, Australia, the United States, and Europe. Their focus on business parks, industrial properties, and data centers positions them well in sectors that are seeing growing demand, especially in the wake of digital transformation trends. One of the key strengths of A17U is its diversified portfolio. This diversification, both in terms of property types and geographical locations, provides some resilience against market fluctuations in any single sector or region. The REIT has also been proactive in its capital management. They've been strategically divesting some properties to reinvest in assets with better growth potential. This active management approach could be one of the reasons analysts are optimistic about its future performance. However, it's important to note that REITs can be sensitive to interest rate changes. With the current economic climate and potential interest rate hikes, this is something we need to keep an eye on. Higher interest rates could increase borrowing costs for A17U, potentially impacting its profitability. Another factor to consider is the occupancy rates of their properties. In their latest reports, A17U has maintained relatively high occupancy rates, which is a good sign. But in the ever-changing business landscape, especially with the rise of remote work, we need to watch how this trend evolves. Now, let's talk about dividends. As a REIT, A17U is required to distribute at least 90% of its taxable income to unit holders. This makes it an attractive option for income-focused investors. However, always remember that past dividend performance doesn't guarantee future payouts. So, what's my take on all this? The unanimous strong buy rating from analysts is certainly encouraging. The potential 11.55% upside based on the average price target is also attractive. However, as always, I encourage you to do your own research and consider your personal financial goals and risk tolerance before making any investment decisions. Keep in mind that the real estate market can be cyclical, and global economic factors can have a significant impact on REITs like A17U. While the current outlook seems positive, it's crucial to stay informed about any changes in the market or the company's performance. For those of you who are considering adding A17U to your portfolio, I'd suggest looking into their latest financial reports, keeping an eye on their occupancy rates, and monitoring any news about their property acquisitions or divestments. Remember, diversification is key in any investment strategy. While A17U looks promising, it shouldn't be the only stock in your portfolio. Consider how it fits into your overall investment plan and how it aligns with your financial goals. If you guys enjoyed this deep dive into CapitaLand Ascendas REIT, then you're going to love my video on top 5 Singapore REITs for passive income. In that video, I break down some of the best REITs on the Singapore market for those looking to build a steady stream of passive income. It's a great companion piece to this analysis, so be sure to check it out next. Thanks for tuning in to the Investing Iguana. Until next time, keep growing that wealth.